Hello accounts people, time to have a look at the more theory based side of financial accounts preparation. What we want is for you to be fully familiar with all the terminology and the ideology, including the PowerPoint at least. It is an unlimited topic, we're not quite sure where it ends because the nature of accounts is so big. You can turn it off so that there's very little of my voice, and I've included very little animation because this just distracts. You might want to pause it to stop and take a few notes. If it's animated, you might miss a line or two. There's a bit of overlap between the ownership, legal status, structure and financial statements. I've tried to minimise this, so if there's a bit that you think belongs in a different section, that's why I've mentioned it somewhere else. The overriding concept, the purpose of financial statements. They are to provide users with information about an organisation's financial performance, how well they did, usually over the last year, financial position, the balance of assets and liabilities, and then changes in the financial position. Is there more equity, capital in the business than last year, or is it shrinking? The key definition here being presenting a true and fair view of the financial position of the business. And we're providing them to users. The users, they are going to make decisions based on the information we give them. So the primary users are the sole traders or partners themselves, and then for limited companies, investors, the shareholders and members, or potential investors, people who might want to buy their shares. And then also for both types of business, or all those types of business, lenders and potential lenders, they'll look at the financial statements to decide are they going to get their money back if they give them a loan or offer them trade credit. We also have secondary users. These are usually defined management, the regulators like HMRC and Companies House, employees, other individuals. This really only applies to limited companies only because limited companies accounts are widely available to different people. Sole traders are only seen by the sole traders, and then they make a completely separate submission, nothing like the accounts, to HMRC for the self-assessment return. And they make decisions based on the financial statements. Nice simple one: whether to give them trade credit, whether to buy more shares or sell the shares. Employees, the secondary users, might decide to look for another job, or we've done really well, we're going to get a pay rise this year. Managers will be comparing how well has our business done against our competitors. HMRC will compare tax returns with what goes off to Companies House to see if it represents a fair amount of tax, or how much adjustment people have made or accountants have made. Other important information, so odd bits here. The 3 ISs you're expected to know the basics of: 1, 2 and 16, separate little slide on each one, but 2 and 16 came up in advanced bookkeeping in detail. And also, you don't need to be fully qualified to start preparing financial statements for anyone. If you've got limited experience, so bear in mind if you're an AAT member, you do have a professional body and a code of conduct. Always get your work checked by somebody who has and maybe got the appropriate qualifications. Also, right, a misunderstanding sometimes. In a limited company, the shareholders are going to use the financial statements to decide how well the directors have performed over the last year since you appointed them. Directors are appointed on an annual basis. The directors themselves don't need to use these statements, although they're going to have to stand up and answer questions to shareholders on them. But actually, directors of a business have far more information about the business than is in the financial statements. A lot of it's hidden. And we'll get it precise now. The actual definition of the types or forms of organisation is legal status. Whether you're a sole trader, a partner, LLP, limited company, is defined by legislation, so it's a legal status. Common questions: qualities of financial information. So the fundamental qualities of financial information. Relevance means information that is relevant to the decisions of users is included. They don't know about brand names, reputations, marketing campaigns. They need to know the financial side. And then faithful representation: everything is in monetary terms, as good as we can make it. And then the supporting or enhancing qualities, different practice papers have used different terminology here. Comparability, being able to compare this year's against the previous year's, means taking out changes and mergers and stuff like that. Verifiability, we need to prove our calculations. Timeliness, well, you have 9 months to file a private limited company's account, 6 months for public limited company's accounts. And understandability is very important actually when you're looking at the difference between sole traders and limited companies. We want to make it nice and easy for our sole traders to understand the financial effects of what they've been doing for the last year. And then an old concept, materiality or material misstatement, means that any error or omission that may affect the decisions of users, so we need to avoid material misstatements. So one of the two underlying fundamental assumptions is our going concern. That means the business will carry on pretty much the same form, no significant reductions in activity. What would happen? Well, if you're going into liquidation or closing down loads of branches, your assets, you've got a carrying amount of them, but it would be wrong. You valued it at historic or current or present value, but actually you're going to sell them off quickly through an auction house and you're going to get a lot less money for them. What's more, you will know the value that you're going to get for them in a very near future, so we can put the proper amount in our accounts. And then receivables and payables, the settlement amount, how much we're going to get from our customers and how much we're going to pay to our suppliers. The other underlying assumption, the accruals concept, again, lots of work done this on advanced bookkeeping. This is about the cost or revenue in the correct time period. So when we do depreciation, we're spreading the cost of an asset over its lifetime. When we do an accrued expense, we've had the bill, we've earned the cost, we've used the electricity, and we're making sure we include that cost of electricity in our accounts, even though we haven't had the bill yet. Most of the other adjustments are to do with fair value, so writing off irrecoverable debts and allowance of doubtful debts is all about the fair value of the asset of receivables. So this one really applies to the limited companies only, but you do need to have an overview as to what it says. The 2006 version redefined the limited company. There have been Companies Acts going back to the 1800s, and every now and again it gets updated, a few extra paragraphs added to it and a few paragraphs taken out, and every 10 years or so they have a major rewrite of it. So the previous big rewrite was in 1996, which is the one that took off the need to have two directors, one of whom is a company secretary. But limited companies make sure that the directors are responsible for almost everything, really. Fiduciary management, making sure the business is financially solvent and well balanced. Actually preparing the financial statements, they don't have to do them themselves. They can employ a firm of accountants to do this, but it's the responsibility of all the directors, not just the financial director, to make sure it happens. It's also the director's responsibility to make sure they're sent off to Companies House at least annually. It's the director's responsibility to make sure that adequate financial records are kept and to make sure they report to the shareholders at least once a year. And then they will also sign off the financial statements, so literally on a piece of paper, sign them off once the shareholders have agreed that they're accepted. And downside is their remuneration will be reported in the financial statements. So this is one of the three ISs. IS 1 is the one that tells us the structure and contents of financial statements for limited companies. Now, why does this matter to sole traders or partnerships? Well, actually, if I was preparing a set of accounts for a sole trader, I would want to be able to sign off at the bottom, I have prepared it in adherence to IAS 1 and all the relevant other international accounting standards, because it looks good and it gives a bit of validity to it. So mainly it defines the purpose of the financial statements. We already mentioned that one. It also says what's a complete set, so we'll have a look at the others later. Statement of profit and loss, statement of financial position, statement of changes in equity, cash flow statements, and the notes. That's the loads of pages that you see after a company's accounts. Some public limited companies, you'll see 4 or 5 pages of accounts and then 30 pages of notes on it. It also defines what is required as line items. In other words, this item has to have a line by itself in our financial statements, whether it's assets or expenditure and what we have to display clearly. And it also defines the elements: assets, liabilities, equity, income, and expenses. They're the elements of our financial statements. IAS 2, lots of this in advanced bookkeeping, so fairly quickly. You should be familiar with lower of cost and net realisable value. Why we don't use LIFO, because if prices are going down, we'll overvalue our inventory. Defining inventory as materials, components, goods for resale, work in progress and finished goods. And why they're a credit entry, well, that's because we're taking them off the purchases because they're next year's cost of sales because we haven't used them. And then IAS 16, some of this in advanced bookkeeping and the costing exam. So IAS 16, property, plant and equipment, defines it as something that will generate for us future economic benefits. We're holding it, controlling it for use in production or supply. It's going to last for more than one period. That makes it non-current asset as opposed to a current asset. How we measured it, go back to advanced bookkeeping, task 1 and task 2, what we include in the cost. The definition of depreciation as the systematic reduction in the value, that's come from IAS 16. And derecognition, when we either dispose of it or we're no longer going to use it or it's no longer got any value to us, and we take it out of our accounts. So now on to the difference between our legal status, our types of organisations. So legal status first, and ownership. So sole traders own their business. They're the same entity. The individuals and the business are the same legal personality. Partnerships, again the same. They're the same legal entity. But after that we get it incorporated. So that means a business has a separate legal status. Incorporated, it has a body. Corpus, body and head. So LLP is a limited liability partnership, bit of a hybrid between partnerships and limited companies, and they're owned by their members but they have a separate legal entity. Limited companies, whether it's a private limited company or a public limited company, they're owned by their shareholders but it's a separate legal entity from them, so you sue the company, not the owners. Charities are owned by trustees on behalf of the public. You can have your own charities, but if you haven't got specific trustees, they're owned by national trustees. And then incorporation is the separate legal status. Formation, well, to be a sole trader, all the sole traders to some extent, go online to HMRC's website within 6 weeks of starting business, otherwise you'll get a fine, if they find out anyway. You're now acting as a sole trader. You're in complete control. One of the advantages of being a sole trader: total control. Your business, your decisions, your risk. That's the downside. Partnerships. You need to agree that you're in one. Very awkward sometimes. Lots of people work together. They work with their best mate from school for 20 years. Are they partnership or not? Very awkward sometimes. There are rules that say you are a partnership. Plenty of legal disagreements are when somebody decided you are in a partnership and the other person said you're not. The old adage about being 2 to 20 members is generally okay, but if you get more than 4 or 5, it's time to turn into a limited company, or at least an LLP. It is always a good idea, really, to form a partnership agreement. The Partnership Act of 1890 applies as a very old piece of legislation. All partnerships or partners have to agree, and you get equal splits of profits and all sorts of rules. No allowance for interest on capital or anything. So most partnerships will have a solicitor drawing up a separate agreement. Limited companies, very easy to set up a company for yourself, but then again you also have all the legal responsibilities of having to do so, including the filing of the annual accounts, which of course costs if you're not going to do a lot with it. You can go online through one of the many portals or Companies House directly before 10 o'clock one morning. If you have got a British registered credit card, you can be a director of a company before 2 o'clock in the afternoon. That looks very good on your CV or on your Tinder profile. But once they're set up, you've got all the regulations and you have to do as you're told. Companies House aren't very forgiving if you fail to meet your legal requirements. Charities also set up via the same way, but then they also register with the Charities Commission and get the exemptions on corporation tax. The structure then, well, sole traders don't have to have any formal structure. It doesn't stop you employing somebody, but you have to be very precise about the responsibilities of anybody that you employ. You would not like having to sell your house or your car or your jewellery because of the actions of somebody who you employed, trying to help them off the dole or something. Partnerships the same. Partnerships are all equal. Decisions must be unanimous unless we've already agreed it in a partnership agreement. Again, they can employ people, but again, the same risk, the liability issue, which is a future slide. Be very precise about the responsibilities of anybody you employ. Limited companies, so private or PLCs, they're governed by a board of directors. The shareholders appointed them at each annual general meeting, every time they're appointed for a year. Their job is to run the business on behalf of the investors, the shareholders. Of course, in a small business, the directors and shareholders can be the same. You can actually have a single person, limited company, one shareholder, one director. As a limited company, the general benefit, apart from the liability we're going to have a look at in a minute, is that the sources of funding are wider and much more available for a limited company, because a limited company that is in trouble can be sold, whereas you can't sell an individual sole trader. So charities, they're run by the trustees. Obviously some charities are huge international organisations. If you have lots of trading activities, you would form a friendly, what used to be a friendly society, or a separate limited company for public benefit. And that gives all its profits to the charitable causes for public benefit. Specific rules, Charity Commission doesn't like charities selling alcohol, for instance, or tobacco products. Sole traders, and so this is the liability issue. The downside of being a sole trader, you are responsible for any debts and legal issues for the business entity. It's legally the same as you, so you will get personally sued, bankrupt if necessary, and you have to pay off any debts for your personal assets. That's what we call the unlimited liability. The next bit is misunderstood and frequently misquoted. Limited companies have unlimited liabilities. The debt never disappears, even if the business closes. If somebody wants to reopen that business, they would have to pay off the debts. It's the owners that get the limited liability, usually the amount they've invested, but occasionally there might be a guarantee, particularly if they're a director against a loan, so they might sometimes have to cough up a little bit more than the money they've lost. Partnerships, well, if you've got an LLP set up, that's separate legislation. There's a specific bit of legislation for LLPs. This limits their liability. Otherwise, they've got liability not just for their own debts, but the other partners. So in the worst case situation, a partner has taken out a huge loan, put the money into their own personal bank account and skipped the country, and the other partners go bankrupt or have to pay it off. Vicarious liability for the actions of others. And charities will have an agreed liability, quite often £1. This is profit appropriation. The bottom parts of the statement of profit and loss, what we actually do with the profits that the business has made. It doesn't matter what type of business you are, the same sales and the same cost will end up at the same profit. It's after that it changes. So sole trader will be entitled to all the profits. That's what they're going to pay income tax on, the profits. And they'll fill in the self-assessment return personally at the end and pay income tax. There might be a couple of little adjustments to the actual amount because of tax rules, but not much. Drawings are the amount of money the sole trader has taken out of the business. Nothing to do with the tax liability. They pay tax on the profits whether they're drawing it out or not. And what they're actually doing is reducing their own capital when they do so. Some level 2 teachers cheat and try and tell you that drawings are an expense. They're not, they never have been. They're the owner reversing capital injections. Sole traders, often there will be questions on this. They take items for their own use because it's very difficult. You go out and buy some stationery and then your children use it to draw some pictures. You've effectively taken some drawings. If they start to use personal assets, maybe a laptop or their own car for business use, transfer it to business use, that's added to capital as capital introduced as well. Or if they put some money in out of their own personal bank account, that's capital introduced. Credit capital. Debit the bank. And in the capital section, or the finance by section of the statement of financial position, at the end of the year it will be the opening capital, what they started off with, plus their profits minus drawings, and that gives you the closing capital. It's the closing capital we're interested in at the end of the financial year. And then partnerships. Well, what do partnerships do differently? Well, pretty much the same most of the way down, and the profits are all the partner's own profits. But what we have to do, I'm sure you've seen this, is to appropriate the profits between the partners. And then they'll individually complete their own self-assessment returns and pay income tax personally as individuals. The balance between what they're entitled to from profit shares, interest on capital, partnership salaries, etc., all the partnership issues, that is recorded in the current account once we've taken out a few drawings, and that's part of the capital section, about adds to the capital at the bottom of our statement of financial position. Limited companies, slightly different. Profits for a limited company are first taxed, so the corporation tax is now an expense of the business, not the owners. And then dividends are given out of the profits. This is your share of the profits to the investors. It has to be agreed at an annual general meeting before it happens, and the shareholders take their money whenever it's given out to them. The rest can now remain in the business, increasing the equity as retained earnings. So the equity, the equivalent to the capital section for limited companies, has a retained earnings section in it. So the financial statements themselves, in terms of the overall what they look like. So sole trader accounts, no formal structure. They just provide information to the sole trader so they can understand what's happened in financial terms over the last year. So it might just be a statement of profit and loss, statement of financial position. We're looking at their own personal belongings, their own vans, their own computers, so we often give them a bit more detail. Sole trader who's got a van because they're a plumber will be more interested in the value of the van than a limited company investor or shareholder will be. Just because we don't need to comply with the regulations doesn't excuse being careful and objective and avoiding material omissions or misstatements. In other words, all our ethical considerations apply, so make sure you are familiar with the 5 principles at least before you walk into the exam. And increasingly, sets of accounts for sole traders are being drawn up in a similar format to the limited company format. Partnerships, very similar, no formal structure. I have done a separate video with some worked examples on it. They just provide information to the partners. Again, pretty much the same. We're looking at their own personal belongings, so give them a bit more detail because they can relate to it. And then we have the appropriation account. So this is one of the new financial statements, or part of it. We've got to draw it up. There's no formal structure, which is why you've probably seen 2 or 3 different versions of one. And most people say it's the bottom part of the statement of profit and loss, or it could be considered its own separate financial statement. It doesn't matter as long as it's done. And in the capital section is now both the capital and the balances on their current account, not just the capital section. So, like sole traders, the net assets are the balancing figure. We work it out to the net assets, which is non-current assets plus current assets minus current liabilities is the net assets, and that balances off with the capital in the business. But these will be different. The limited companies change. We've now got lots of regulations, got to be prepared, presented and agreed at least annually. We've already mentioned Companies Act 2006, IFRSs and IASs and IAS 1. So The statement of profit and loss does exactly the same function down to the profit for the year. It'll be the same end figure for a sole trader, but there's less profit figures, so we've only got 4 expense figures in a statement of profit and loss for a limited company, which means things like depreciation that we've showed as 1 or 2 rows in a sole traders. If it's depreciation on our plant and equipment, it will be added to cost of sales. If it's depreciation on our vans, we add it to our distribution expenses. If it's our computer equipment, we'll add it to our admin expenses. So the actual numbers, but the bottom line figure should be the same. The main changes are really in the statement of financial position. The assets section's the same but simpler, 1 column. So no cost, no accumulated depreciation, just the carrying value by class. And the total assets, so add non-current to current assets, that's the balancing figure, the top half. And then instead of going down to current liabilities, we have the equity section next. Equity section will be share capital, the face value of the shares in the business. Share premium, well, after a few years trading, they're worth more than the face value, so we sell them, or reissue some, or issue some more shares at the same value, higher value rather. And then the difference is in the premium account. Retained earnings, so this is the money that we've made, but we haven't, that we've made the profits, but what we haven't paid out in terms of taxation or dividends to our shareholders, and any other reserves like revaluations where properties gained. And then we go down to our non-current and current liabilities, and we've got a new version of the accounting equation. Assets equals equity plus liabilities, adds up the same way round, it's just better explained this way. And the last section of our financial statements for limited companies, the notes, they are the 5th section in a way, 5th document. So let's have a look then, other rules and bits and pieces. So these are our 2 additional financial statements. One of which is our statement of changes in equity. Nice simple one. It shows the changes through the year in the equity of the business. So it shows us issuing shares to provide more capital, revaluations, dividends being paid out, what we retained in terms of profits, and sometimes we move money from one section to another. It actually separates the equity between owners' investments, what they put in, share capital and share premium, and then the generated equity, the retained earnings from trading and revaluations, that's from being a business. Cash flow statement, much longer one, takes 3 lessons at least on level 4 courses, 3 lessons of 3 hours. It explains why the cash and equivalents hasn't gone up or down by the same amount as the profits. There are lots of reasons like this, simplest one of which is possibly our customers owe us lots of money. So it doesn't affect our profits, we've just got a massive increase in our receivables and our bank account is suffering as a result. What you need to do is to understand what's in them, potential tick box question. You won't need to complete them, that's a level 4 topic. So all I can say is work hard and then you'll get the good luck that you deserve. Plenty of practice papers. Make sure, if you can, have a look at all the 3 main publishers as well as the AAT ones. Just bear in mind that we can't provide a totally comprehensive issue here. We can just do our best.